Okay, Assalamu alaikum and good evening to everyone. I think rest of the students they just want to see the recording of this live revision class. Okay, I'm fine with that. Since it's a first class, so it will not be very long. We are starting from cost of capital, and slowly and gradually the time period of the class will increase, and the frequency of classes from one per week it will go to at least two per week, inshallah. So let me share the page. Okay, before I start the class, I think Alishan, I know how many lectures he has seen. Can you both of you can you tell me how many lectures each one of you have seen so far? And
Sir,
please try to follow
around
the planner
30.
which admin has shared with you. If you are ahead of planner, then there's no issue at all. But you should not be behind the planner. If you're ahead of planner, then everything is fine. Otherwise, there's a little problem. Around 30, that's really good. What about my second student? That's great. So, live revision classes, AFM, March 24. Let's start the first topic, that is cost of capital. But from the next class, as I mentioned earlier, the time period of the duration of the class and definitely slowly and gradually, frequency of the classes will also increase. We're starting the first topic, that is cost of capital. First point, cost of capital. The objective of cost of capital is investment appraisal. So if somebody is asking you what is the objective of cost of capital, the objective is investment appraisal. That is the objective of cost of capital. Second, what actually cost of capital represents? It represents cost of financing. Cost of capital actually represents cost of financing. So cost of capital represents cost of financing. Okay. When we say cost of capital, so let us see what are the sources of finance which are available to raise the finance. Organizations, they can raise the finance in the form of equity. If you are raising the finance in the form of equity, then the cost is KE, cost of equity. If an organization is raising the finance in the form of debt, that is, which is loan, then the cost is KD1 minus T, that is cost of debt after tax. Why cost of debt after tax? Because the fixed payment of interest results in tax saving. That is why it is not, your cost is not KD. Your cost is actually lower than the KD. Your cost is actually KD1 minus T because the fixed payment of interest results in tax saving. Third and the last one, which you might not see in AFM actually, normally, but it is in the syllabus, you should know that is preference shares. If an organization is raising the finance in the form of preference shares, then the cost is KP, that is cost of preference shares. Please rejoin. What about rest of the student? Can you please hear me? Alishan can hear. So Salman, please rejoin Salman again. Okay, now let's How can we calculate K? Actually, K we can calculate. For calculating KE, we have one model which is CAPM, Capital Asset Pricing Model. The second is Dividend Valuation Model. Another name is Dividend Growth Model. We do have MM plus tax equation also. But we should not be expecting a question on MM plus tax equation in AFM due to the introduction of CB. But we should be mentally prepared. If it comes, we should be in a position to tackle with that. But chances are, I think, almost zero. So for calculating K, we have capital asset pricing model, we have dividend valuation model, we have MM plus tax equation, which is actually MM plus tax equation is the alternative of CAPM. Now let's see capital asset pricing model. K is equal to RF plus RM minus RF and then equity beta. K is cost of equity. Okay, that's great. K is cost of equity. Another interpretation is minimum return required by shareholders. Minimum return required by the shareholders. Actually, it is cost for the organization, but the same thing is return for the shareholders. RF is risk-free rate of return. Risk-free rate of return. Basically, when we make investment in government bonds, so investment in government bond is treated as a benchmark for risk-free rate investment. Because normally we believe that governments, they don't collapse. That is why if an organization is making investment in government bonds, then we'll consider that investment as risk-free investment. So RF is risk-free rate of return. RM is average return on a stock exchange. Average return on stock exchange. RM minus RF, the difference is called equity. Risk premium. Another name is market risk premium. Before developing the understanding of beta equity, we should know little bit, a few things relating to beta. When we say beta, actually beta is a measure of risk. Beta is a measure of risk, and we have two types of risks. Systematic and unsystematic. Unsystematic is a diversifiable risk. Diversifiable risk. If an organization has made investment in more than one organization's shares, then we'll say you have diversified your risk. Normally, in capital asset pricing model, we make an assumption that investor is having a well-diversified portfolio of investment. That is why in CAPM, actually, we assume that unsystematic risk is zero. Systematic risk is not a diversifiable risk, not a diversifiable risk. You cannot diversify. For example, if government increases the interest rate, that is an example of systematic risk. You can't do anything. If your currency is being devalued, you have to face it. Systematic risk. So basically, if your government increases the scope of the tax, sales tax, if the scope of the sales tax is increased, that is also an example of systematic risk. Even the political instability is also an example of systematic risk. So systematic risk is not a diversifiable risk. If we talk about beta equity now, we say actually beta equity is a measure of systematic risk. Why we are saying that beta equity is a measure of systematic risk? Because in capital asset pricing model, actually we assume that investor is having a well-diversified portfolio of investment, and that is why unsystematic risk is zero. So obviously, when in CAPM, we have made an assumption that unsystematic risk is zero. So there's only one risk, which is systematic. So beta equity is a measure of systematic risk, which actually indicates that how your investment will respond to the changes in a stock index. For example, if the stock index has increased by, let's say, 4%, assumption, and let's say your investment has increased by, let's say, 8%, I'm just assuming. If index is increased by 4%, and let's say your investment is increased by 8%, just an assumption. Since you are earning more than the market, so we'll say your investment is a riskier investment. Your investment is more riskier than the market. Because index has increased by 4%, and assuming your investment is increased by 8%, since you are earning more than market, if it means that if the index is going to decrease, then your investment will decrease by the twice as compared to stock index. So whenever you are earning more than the index, then normally the interpretation is your investment is more risky than the market. Now, if for example, if you have a beta equity zero means organization has made an investment where there's no risk. If you have made an investment which is risk free, then your KE must be equal to RF. So whenever beta equity is zero, the KE must be equal to RF. Second, if the beta equity is less than 1, if the beta equity is less than 1, it means your investment is less riskier than the market. When your investment is less riskier than the market, then logically KE must be lower than RM. When your investment is less riskier than the market, then logically your KE must be lower than RM. Third, if beta equity is exactly equal to 1, when beta equity is exactly equal to 1, we treat this beta equity as a benchmark beta, which means that beta equity 1 is actually representing that stock index systematic risk and your investment systematic risk both are equal. So beta equity 1 is a benchmark beta. Whenever beta equity is equal to 1, your KE must be equal to RM. Fourth finding. If your beta equity is more than 1, it means your investment is more riskier than the market. When your investment is more riskier than the market, then you're going to demand a return which is more than the market. So actually, we have 4 findings in capital asset pricing model. You can see one thing. Either your KEs will be equal to RF, will it be lower than RM, will it be equal to RM, or will it be higher than KE will be higher than RM? Actually, it depends on beta equity. So simply we can say that KE from CAPM actually relates to systematic risk of investment. So actually, whatever the KE comes, it actually depends on the beta equity. In other words, KE from CAPM actually relates to the systematic risk of your investment. Second model is dividend valuation model, DVM, dividend valuation model. K is equal to D naught 1 plus G upon P naught plus G. K is of course cost of equity. I'm not doing any numerical example of capital asset pricing model because in regular courses, obviously you have seen a number of questions on that. Since it's a revision class, so I'll be just highlighting the main concepts. Again, K is cost of equity. Another name is minimum return required by shareholders. Minimum return required by the shareholders. G is annual dividend growth rate. Annual. In dividend valuation model, actually, we assume that annual dividend growth rate is constant. P naught is current share price X div, excluding dividend. Whenever nothing is mentioned, then we assume that given share price is X div. If the price is going to be cum div, cum div means cumulative of dividend, cum div means including dividend. Whenever examiner wants to give cum div price, then it will be mentioned in the question that given share price is cum div. Otherwise, nothing is mentioned, no hint is given, nothing at all. Then we normally assume that given share price is excluding dividend. D naught is current dividend per share. That is current dividend per share. D naught, which is current dividend, 1 plus growth rate. If we multiply current dividend with, and we increase this current dividend with annual dividend growth rate, then we'll get D1. So D naught into 1 plus G is equal to D1, which means next year expected dividend. Next year, expected dividend. It simply means if it is D23, then 1 plus G will give us D24, expected D24. Okay. The formula is K is equal to D naught, 1 plus G upon P naught plus G. Sometimes we use the same formula to calculate P naught also. It depends on the data. For example, it could be like this. P naught is equal to, if I make a P naught as subject, then the formula becomes like this. Okay. Sometimes what happens, examiner gives you the information of dividend for more than 1 year. So whenever you have been given information of the dividend for more than 1 year, then you have to calculate the annual dividend growth rate. How do we calculate? Let me show you. For example, if examiner says dividend per share is $0.4 in 2000, let's say 20. Dividend per share is, let's say, 0.42 in 2021. If it is 4.8 in 2022, and we are ending towards 2023. For example, if this information is given, and let's say we need to calculate annual dividend growth rate. So it's very simple to calculate. First, you have to write the last dividend, which is this, divided by the first dividend. Yeah, we have a data of 4 years. Why 1 by 3? Because 4 years data is given. So you have to minus 1. So please recheck. 0.5, 0 divided by 0.4, the power is 1 upon 3 minus 1. It is 8%. Please check. So last dividend divided by first. If the data is of 5 years, then power is going to be 1 upon 4. If the data is for 4 years, then power is going to be 1/3. It is 7.72, 7.72 to be exact. Okay, make it 7.72. So one of the possibilities of giving you the information relating to the dividend is this. Another possibility of calculating annual dividend growth rate is by using Gordon growth model. Gordon growth model. Gordon growth model. Sometime examiner gives you the information and you need to use Gordon growth model. Obviously, it depends on the information. Let me first give you the formula. G is equal to B. The formula in AFM, it is little change. Like in FM, it is B into RE. We use this formula in FM. AFM, it is bit change. G is equal to B K. This is what we use in AFM. B is the retention ratio. For example, if organization is paying 40% dividend, it means they are retaining 60%. And you must know one thing, you should know one thing. Organization, they always retain to reinvest. Organization, they retain to reinvest. So if organization is paying 40% dividend, it means they are retaining 60% to reinvest. If organization is distributing 30%, it means they are retaining 70% to reinvest, which means that we can calculate retention ratio like this. B is equal to 1 minus payout ratio. How do we calculate payout ratio? It's very simple. Dividend per share divided by earning per share. Perfect. So K, we know that is K's cost of equity. So sometime obviously it depends on the given information. You might be required to use Gordon growth model to calculate annual dividend growth rate. EPS, obviously we know that. Profit after tax divided by total ordinary shares. Nobody is expecting in AFM to use IAS 33 to calculate weighted average shares. Simply profit after tax divided by total ordinary shares. Now, if I talk about debt, loan, if organization is raising finance in the form of debt, then we know that the cost is KD, cost of debt after tax. But when it comes to debt, loan, dear students, you have to be, very, very wise to deal with loan. Why? Because there are different types of loans, and each type of loan is having a different method of calculating KD1 minus T. If I start from the bank loan, for example, bank loan, it's very simple in case of bank loan to calculate KD1 minus T. For example, if we are having a 10% bank loan, and let's say the tax rate is 20%, then KD1 minus T will be 8%. So in case of bank loan, actually, we assume that book value of bank loan is equal to market value. So whatever is the interest rate of the bank loan, all you need is just do it 1 minus T. Okay. Second, irredeemable bonds. KD1 minus T is equal to I, which is the cash interest. 1 minus T upon P naught. And let's say into 100 so that we get the answer in percentage. KD1 minus T, we know that that is cost of debt after tax. P naught is current bond price X interest. Nothing is mentioned, and given bond price, we will assume it is X interest. In case of common interest, they will have to write I is the cash interest, and T is the, of course, tax rate. For example, if we have 12% irredeemable bonds, let's say the current bond price is 115. Nothing is mentioned, par value is, we always assume 100. Let's say the tax rate is 20%. And we just need to calculate KD1 minus T. Cash interest is always paid on par value. So obviously 12% of 100 is 12 into 1 minus tax rate. Nothing is mentioned, and given price is always we assume X interest. Can anyone use the calculator, please? What is the percentage? KD1 minus T. So 12 1 minus T divided by 115 into 100. What is the percentage of KD1 minus T? Answer. Right now, I don't have the facility of calculating. Why it is taking so long? I think it is 8.3478. Please check. Okay. 8.3478%. Great. Okay, now let's go for the third type of bond. That is redeemable debt. Now listen and listen carefully. Most of the time, if there is a cum div, then you need to just deduct the interest. If the price is cum div, for example, let's say we have 12% irredeemable bonds. Par value is 100. Let's say the current bond price is 118 and the examiner says there is cum interest. I'm taking tax at 30%. So let's calculate KD1 minus T. If I take 12% of 100, obviously it will be 12 into 1 minus T. Now what you have to do, since it is cum interest, so from 118, I need to deduct 12. It will become 106. 10. So what is the percentage now? What is the percentage now? So 12 into this. It is 7.92. 45%. It is 7.9245%. Okay. Actually, as I was telling, most of the time you will face redeemable bonds in AFM. How do we calculate YTM for redeemable bonds? That is very important. Actually, the first approach of calculating KD1 minus T for redeemable bond is YTM. The first approach in AFM is YTM. We directly don't go for FM approach. We first go for YTM, yield to maturity. What do? How do we calculate YTM? First, you have to take RF plus credit risk premium. Now, what is the logic behind that? Let me tell you. For example, let's say, assuming your bonds are having a maturity period of 4 years. Your bonds are having a maturity period of 4 years. Then first in the question, you need to see what is the government bond rate, what interest rate government bond rate is offering when the maturity is 4 years. What interest rate government bond is offering when the maturity period is 4 years. So actually this RF means government bond rate. You have to take that government bond rate. Since your organization bond is riskier than the government bond, so you have to add credit risk premium, and CRP will always be given to you. Credit risk premium will always be given to you, even though we can calculate CRP by using Black-Scholes option pricing model, but it is not in our syllabus. So anymore in AFM, used to be the way back, not now. So let me repeat. The first priority for calculating KD1 minus T for redeemable bond is YTM, yield to maturity. Actually, when we are calculating a cost of debt after tax, it means we are actually trying to calculate return required by the debt holders. So how do we calculate YTM? Let me repeat again. If your organization redeemable bond is having a maturity period of 5 years, then in the question you have to see what government bond is offering the rate when the maturity is 5 years. Take that rate plus add the credit risk premium relating to your organization's credit rating. It will be again given to you. Actually, this YTM is also called KD because it is written for the investor. The same thing is cost for the borrower. So once you have calculated KD, then all you need is just do it 1 minus T. I would say 99%, or if to be more precise, 95% you will be using YTM approach to calculate KD1 minus T for redeemable bonds. So how do we apply this? Let me repeat again. First, you have to see what is the maturity period of the organization bond. Then in the question, you have to see at the same maturity, what interest rate government bond is offering. Take that rate as RF, then simply add credit risk premium. It will directly give you YTM, another name is KD. Once you have calculated KD, then all you need is just do 1 minus T. Now listen, if YTM approach is not applicable, only then you will go for FM approach and calculate KD1 minus T by using IRR. Repeat, but let me tell you one thing again. You are not supposed to directly go for FM approach. If YTM approach is not applicable, then we calculate KD1 minus T by using FM approach, in which we actually use IRR to calculate KD1 minus T. What is the format of calculator? What do actually we need for calculating KD1 minus T by using IRR? What are the inputs? We need to discuss that. And we also need to discuss the preference shares. If your organization is raising the finance in the form of preference shares, and we do have two types of preference shares, one is redeemable and another is irredeemable. In both the cases, how will you calculate KP? So actually, I need to discuss three things. One, if YTM approach is not applicable, then you have to calculate KD1 minus T by using FM approach. What are the inputs which we need for FM approach? We need to discuss that. And then after that, we will be discussing when organization raises the finance in the form of preference shares. And we know there are two types of preference shares. One is irredeemable and another is redeemable. And how do we calculate KP in both the cases? So these are the three things which actually we need to discuss. And then we'll move on a cost of capital formula and different things. We'll be discussing other concepts as well. Since it is the first class of our March 2024, as I mentioned earlier, this class will not be very long. But let me repeat again. Slowly and gradually, the time period of the revision class will increase, and the frequency of classes from one, it will go to at least 2 classes per week. So it is the first class. I'm ending this class over here. And I would say, have a nice life, because I always say to my students, having a nice day is okay, but since the life is itself very short, so I want my students to have a nice life, just not have a one nice day, have a nice life. So thank you very much, and I'm expecting more students in my coming weekly live revision classes. I would appreciate if you people also motivate in your respective WhatsApp groups to other students that they should come up in the live revision classes. Coming class will be on Sunday, inshallah. So more detailed admin will announce, inshallah, I think by tomorrow. Don't worry at all. And the recording will be available. Obviously, we will continue cost of capital. Still, number of concepts of cost of capital are still left. So we will continue cost of capital. So recording will be available, inshallah, within half an hour. Recording will be uploaded. So thank you very much. Have a nice life. Assalamu alaikum to everyone.